Hello everyone, welcome to our channel India Equity Investing. Today we will review the Q1 FY24 performance of Anup Engineering. Before we start the quarterly results review, I would like to highlight that in case you want to develop a better understanding of this company, then please review the detailed company review and previous quarterly performance review that was done by us before seeing this presentation. The links for these two presentations are given in the description below. Reviewing them in this order will help you develop a much better understanding of this company. So we will start by reviewing the quarterly performance of the company, key points highlighted by the management, update on Kheda plant, and the future outlook for the company. After this, we will review the updated financial model and evaluate the ROI potential that exists as of today. The company reported better than expected results for the first quarter ending FY24 with total revenue of 125 crores as compared to 52 crores in the corresponding quarter of last year. Now, the annual comparison of revenue here, it's not a great measure because the company follows the delivery method for revenue recognition instead of the percentage of completion method. So, due to this reason, the smoothness in revenue cannot be expected, you know. And now, if we look at the total revenue guidance given by the company for this year, which is in the range of 520 to 530 crores, and the quarterly revenue that it has already achieved of 125 crores, what this basically implies is that the quarterly revenue run rate for rest of the year is likely to remain stable and will see marginal growth because the Q1 performance has already been much better than anticipated. The key metric to track for us during this quarter was the EBITDA margin. Now the company has performed very well in this regard, where we saw some mean reversion taking place, with EBITDA margin increasing by 420 basis points to 22.4%. Now, since these orders were booked at the peak of the commodity cycle last year, so the margins were expected to increase during this quarter as the raw material prices have declined. Please note that the company does not operate on a cost plus basis, so any increase or decrease in raw material prices is directly borne by the company. So what the company does over here is that it books the orders, the new orders at 22 to 23 odd percent EBITDA margin, and then after that any increase or decrease in raw material prices after the order has been booked is borne by the company. Now this significant growth in revenue and increase in EBITDA margins have resulted in over 3 times growth in the PAT to 18.6 crores during the quarter at close to 15% PAT margin as compared to 5 crores at 10% PAT margin achieved during corresponding quarter of last year. The company saw highest ever order booking during the quarter at rupees 240 odd crores. That brought its total order book at the end of Q1 at 651 crores. This is the highest order book that the company has had in its history. And this provides excellent visibility for the company to not only achieve its FY24 revenue guidance, but also create a strong runway for FY25. Now, oil and gas sector remained the key growth driver during the quarter with 85% revenue contribution. Now, the capacity expansion done by the refineries and petrochemical industry in general is a key growth driver in the domestic market. Now, till last year, the company saw a lot of traction coming in from PSUs, but as of today, the private company spending has picked up, and the current order booking that the company is seeing is equally split between PSUs and private refineries. Now, the heat exchangers contribution also remained significant at 76% of the total revenue during the quarter. But we expect this revenue contribution to go down because as the Kheda facility becomes operational, the contribution from other key products like vessels, reactors, and columns is expected to increase. The another strong point to be noted during this quarter was that exports are now seeing strong traction, specifically in the US and Middle Eastern markets. And the exports contributed around more than one third of the total revenue during the quarter. And 70% of the new orders booked during this quarter basically were from the exports. During the entire financial year, the company expects the export contribution to be in the range of 30 odd percent. Now the company has set up a new manufacturing facility at Kheda, which is 40 odd kilometers away from its existing other facility. Now this is a larger facility that will allow the company to address the entire inquiry basket of the client which could not be addressed earlier due to smaller size of other facility. So what the company said is that if it was getting an inquiry basket of 100 odd crores, it could not address the entire inquiry basket, and it could, address only say up to 70 to 80 odd crores of the basket because of the locational and the capacity constraints that the company had at other facility. Now those constraints will be gone, and it will be able to address the entire inquiry basket that it is going to get. And this plant overall is expected to be set up in three phases that will involve setting up seven manufacturing bays with the total capex spend estimated to be anywhere between 250 to 275 odd crores. Now, the first phase has already been completed. It involved setting up one and a half manufacturing bays at the cost of 120 odd crores. Now, the cost has been very high because this involves taking care of a lot of other aspects also, like leveling up the ground, setting up the plant, setting up the utilities, getting the necessary permissions. So the time and the cost involved in phase one was significantly higher, and the company expects this cost to be significantly lower for the next two phases. And this phase has, already become operational, and the first dispatch is expected during the second quarter of current financial year. And for the current financial year, which is FY24, the company expects this facility to contribute anywhere between 50 to 60 crores to the total revenue, which is expected to be around 150 odd crores in FY25 when you get the full year revenue from it. And the company will have to decide on phase two expansion very soon. And that will involve setting up another two manufacturing bays, and each manufacturing bay takes anywhere between 11 to 13 months and involves a capex of anywhere between 50 to 60 crores. So once the phase two also is fully set up, another 150 odd crores of revenue can be expected from the Kheda facility. So the total Kheda facility revenue contribution in next few years from phase one plus phase two is expected to be around 300 odd crores. The company is expecting to derive significant competitive advantage by focusing on higher complexity products and usage of exotic materials. This overall is what the company terms as value addition that it is looking to do. In terms of higher complexity products, the company, made its first polymerization reactor with the help of European licensing agreement in recent times. This is the first of its kind reactor to be made in India by any company. So, this is something where the company believes it can, now make more complex products going forward, move up the value chain. And secondly, if you see, the company also is focusing on use of exotic materials. So, better metallurgy mix during the quarter allowed the company to generate greater revenue from the same tonnage capacity that the company has at its Odhav plant. So this is again one point that the company has delved on in the past, that with the same capacity as well, it can generate greater revenue by incorporating more precious materials and metals into the manufacturing process. Now, value addition is a softer aspect of this business, but a very critical one, and we covered it in significant detail during the quarter four results review of last year. So I would request you to review the same as well, as that will give you a good understanding of how the company is looking to differentiate itself and create a strong competitive advantage in this market going forward. Now we update our outlook for Anup Engineering based on the latest quarterly results. So the exports are likely to become a key growth driver for the company over the next few years, and its contribution is expected to reach around 250 crores in FY25 from under 80 crores in FY23. So let me put this in perspective that from FY23 to FY25, during these 2 years, we expect the company to generate an incremental revenue of 230 crores. So we expect its revenue to increase from say 410 odd crores in FY23 to 640 odd crores in FY25. So out of this 230 crore increase in revenue, we expect more than 150 crores of increase is going to come only from exports. So that should, put in perspective the kind of revenue contribution we are expecting from exports going forward. And, the EBITDA margin expansion by another 100 odd basis points is something that we can expect from the company over the next 1 to 2 years. So the historical EBITDA margin for the company were in the range of 24 odd percent in the past. And, they saw a decline due to significant increase in raw material costs in FY23, and the company expects the margins to come back. But we expect that it would not be surprising if the company achieves another 100 basis points increase to 23% from what it reported during this quarter. And during this year as well, we expect the company to see some margin expansion because its legacy orders that were booked when the raw material prices were increasing is likely to be fully executed during the second quarter. So during second half of this year, we can expect the margins to increase further. And please note that during this quarter, the company reported 22.4% EBITDA margins. So it can inch up further from there as well. We expect the work on phase two to begin within the next 12 months or so, because in order to for the company to achieve its annual revenue estimates that we believe are likely to be in the range of 700 to 750 odd crores, the company will require the phase two capacity expansion to start by next year. And as of today, what we see is that the company has now entered, a high growth phase, and we expect uh, this kind of momentum to continue in the near term. On this slide, we look at the quarterly performance of Anup Engineering over the past 13 quarters. So you may want to take a pause to look at how the numbers are flowing and how the revenue has increased over time. So if we see, I think the key point is that since Q2 of last year, over the past 4 quarters, the company has consistently hit a revenue of 100 crores, and now seems to be getting in a position where the company will easily hit that mark going forward. And so overall, with a revenue of 125 crores in this quarter, the company achieved a good gross profit margin of around 54 odd percent, which can go up marginally during second half of this year, as previously indicated. And the EBITDA margin again was at 22.4%, which again is pretty good, and though slightly lower than the annual numbers it reported till a couple of years ago. And this eventually trickled down into a PAT of little under 19 crores at 15 odd percent. Now, looking at the income statement of the company, we have increased our FY24 revenue projection to bring it in line with the lower end of the revenue guidance given by the company at around 520 odd crores. We have kept the annual gross margin at around 51 odd percent, which is lower than what the company reported in Q1, because we believe that revenue mix change is likely to take place over the next few quarters, and impact the gross margin, because when the company places in a bid, they are basically focused on the EBITDA margin vis-a-vis the gross profit margin. So after the Q1 results, we have greater certainty of EBITDA margin expansion taking place during this financial year, and hence we have increased our estimates from 21.5% EBITDA margin earlier to now around 22.2% EBITDA margin, which I believe is still the number that the company uh, is likely to achieve easily during this financial year. This overall is going to result in the increase in PAT estimate for us from 70 odd crores earlier to now at 74 odd crores for FY24. The key point to note here is that our out year revenue, if you look at say FY26 and FY27, our out year PAT estimate has now increased by a little under 10%. Due to improving business sentiment, our model now has slight optimism built into it, but there is still, likelihood of this momentum sustaining over the next 2 to 3 years, because the capex cycles generally last for many years. It could be for anywhere between 4 to 7 years. So we believe that with slight momentum and optimism built into the financials in terms of revenue growth and EBITDA margins, the company is likely to end FY26, which we currently have assumed as our exit year, with a EPS of around 117 odd rupees. This slide shows the key cost ratios for the company as of today and what our projections are. So we expect the direct expenses to remain in the range of 49 odd percent and operating expenses to be in the range of 29 odd percent. And overall, we expect the company to attain good return on equity and return on capital employed ratios over the next few years, which allows the company to trade at a premium to its book value as well. Here we see the balance sheet for the company, which is trending largely in line with the growth in the business, and the tight working capital management is, I think, the key attribute that can be seen over here, which will allow the company to grow rapidly and also at the same time generate good amount of cash. So on this slide, we can see the key ratios for the balance sheet. We expect the net working capital days to largely remain flat and see only marginal growth over the next few years. The capital work in progress is due to the phase-wise capital expansion that the company is going to do, and we expect some increase in GFA turns going forward as well. So no changes from our previous comments made on the balance sheet. So here, we can see that tight control of working capital management, increase in asset turns, and sustainable margins will allow the company to generate significant cash flow over the next few years. Now, this is really commendable for a company that is growing at a rapid pace. As of today, the company is trading at 30 times its trailing 12-month earnings and close to 27 times its FY24 earnings. The stock price has almost doubled over the past 1 quarter or so, which now bakes into it the current positive outlook for the company. And given the current financials, the industry sentiment, increase in private capex, and expected growth trajectory for the company, we believe that Anup Engineering is getting re-rated in the market, and this, in our opinion, has increased the probability of getting a higher exit multiple in the range of 30 to 35 times its trailing 12-month earnings. So, assuming the FY26 trailing exit multiple of around 30 to 35 times, we can look at a ROI of in the range of anywhere between 1.8 to 2x, which implies a IRR of around 22 to 29%. So this is a great valuation model uh, if we are looking at an exit, as it has some optimism built into it. But we would never use this kind of metric to make any fresh investment into the company as of today. This slide captures the trailing 12-month P multiple for the company since its listing, and we can see that its trading range has now gone beyond its historical range of anywhere close to 15 to 17 times to now in the range of around 30 odd times. And we believe the probability of the multiple trailing 12-month multiple staying anywhere between 27 to 32 times is quite high. With this, we conclude our quarterly review of Anup Engineering. I hope you found it to be informative, and we look forward to sharing more such interesting ideas with you, and also share results update with you for the stocks that we are currently invested in. Thank you for your time once again.